The role of a risk manager in an era of greater uncertainty is rapidly evolving. Today, risk managers are expected to actually enable growth and innovation. So here at the India Risk Manager Awards presented by ICICI Lombard General Insurance Company, we ask, what is the risk manager's role? You will get insights from a highly experienced group of people cutting across sectors. So let's get on with it. It's time to meet our panel. Starting from my extreme right, Hiranya Ashar, CFO at Rolta. Praveen Sood, CFO at Hindustan Construction Company. Divakar Gupta, former Managing Director and CFO at State Bank of India. Gopal Balachandran, CFO at ICICI Lombard General Insurance Company. Dinyar Manekshaw Jivasha, Group Global Head and Senior Vice President, Corporate Risk and Insurance Management, SR Group. And Ashutosh Ojha, Head of Risk Management and Quantitative Research at Quant Capital. Gentlemen, great to have you all here with us. Simple, straightforward question going to each one of you. What does risk management mean to each one of you? Should we do this in order and start from there?
For a business, you have to take risk, but managing that risk is more important for smooth and sustainable functioning of a business. So we are not denying that risk will be there, but how you efficiently manage risk will depend upon not only the growth of the organization, but sustainability.
Mr. Sood.
Yeah, I think my feeling is that on one hand, if the mitigation of risk is necessary and the whole process goes into it, but in the recent past, I have seen a big hype about it, about risk management, and it started hampering the growth of the businesses nowadays. And my warning is that the role of risk manager, if has to be assessed, it has to be assessed at two counts. One is how far he has been able to mitigate the risk, and obviously how far he has been hindrance to the business and basically responsible for the lost opportunities in the businesses.
Lost opportunities, that's an interesting word, and we're going to explore that and many of the points that have already been raised. But let's see if Mr. Gupta presents a contrary point of view here to what Mr. Sood has just outlined. When I say risk management, what does it mean to you?
Well, I think we all agree that risk is inherent in all businesses. And there is a risk-return matrix. Good businesses are able to balance profitability with the risk they can undertake. The other thing about risk today is that it is multidimensional. And in an increasingly globalized world, risk is going to be much more important because of the stresses, because of the combativeness, because of the competitiveness of industry and the environment. And the third thing is that risk exhibits itself in cycles. So you have times of plenty and good when you typically underprice risk, and then you pay the price by becoming over-conservative, and you see cycles of it. I think the real challenge for risk managers today is to ensure that there is a free, open and frank discussion about risk and an awareness across the organization.
Well, I think that there is an evolution that's currently underway, and we'll take stock of that evolution. But Mr. Balachandran, risk management, really, what does it incorporate in your eyes?
I think the key would be to not only look at identification of the risks, it also involves how effectively you are able to measure some of the risks which an organization is exposed to. And the third element, if you were to look at from a risk management standpoint, is the direction. So again, is it more a compliance requirement which is emerging as a result of which organizations are putting in place risk management? Or is it that an organization is actually wanting to put in place an appropriate risk management systems in place by which they know for sure the decisions on which they are basing their distribution or selling is clearly known, and all that they would be looking for, or the decision would be primarily based on the residual risk. So they clearly understand what risks they are taking, they clearly understand how in the event any risk was to or a loss was to happen, what is it that an organization needs to do, a plan B kind of a thing, and that's what is all risk management is about.
Okay, we're continuing with opening thoughts. Mr. Jivasha, from you now. Should we talk, is it premature to talk about risk managers as having moved beyond this whole regulatory and compliance role to really being drivers, enablers, and partners for growth and innovation within a company? Am I stretching the reality?
Today, risk management has moved beyond the traditional, operation risk and project risk. We are talking of cyber risk, we are talking of media tech, we are talking of employees' practices liability, we are talking of environmental liability, and especially companies like us which deal in the US and the UK, for us, it's a very broad spectrum of things, including credit risks. So, yes, we need to now be part of the think tank, we need to think out of the box, and we need to be driving the company on some of the issues and continuously make them aware, maybe becoming unpopular. Another thing which most companies and groups should realize that risk management is neither a cost center as it is perceived to be, neither is it a profit center. It is a risk management center, and it should be treated with that regard and respect.
On that note, let's move on to Mr. Ojha. Opening thoughts from you on what risk management really means in the Indian corporate landscape here and now.
So the thought which came to my mind is that initially when economic theory started, there were several factors of production: land, labor, capital. Now the problem right now is that we can make money out of thin air. So for example, when you are selling risk, for example, they write insurance, or when you are giving somebody a loan, and ideally you should probably earn a lower interest rate, but suppose if you are giving loan to a real estate guy, suppose if you are giving a loan to somebody who is not able to pay it properly, then risk manager's role is to keep a watch that at what point should you stop. So the analogy which came to my mind is that you can make a lot of money, shine like a meteor and fade away. It's the risk manager who stops you from doing so. So he adds the stability to the business. And I think with advent of competition, as he rightly pointed out, the role has become ever more important because the competition is so high and there are no easy opportunities of making money. So the likelihood of you making mistakes has gone far higher.
Okay, now that we've got opening thoughts from everyone on this panel, we're warmed up. What would you say are the elements of a risk management framework that every company operating in India today, and I know I'm using broad strokes and covering everything from large conglomerates to small and medium enterprises, but Mr. Gupta set the tone. Essentials of a framework for risk management today. Let's assume a large-sized company.
Well, I think you can segment risk into three broad buckets. The first one has to do with what is preventable. Those are things which can be controlled through a set of rules. The second part is risks which are strategic in nature. Let's talk about the bank. You say there is financial risk and there is operational risk, and in the financial risk you have market risk and you have credit risk, and then you have pillar 2 risks. For banks, for capital allocation, you have the entire Basel framework. So we are getting into nitty-gritties, and that's where the risk lies, in not seeing the totality of the function. And finally, you have uncontrollable risks, natural calamities, or geopolitical events, coup somewhere, oil embargoes, and so on and so forth. And that is where you will need to do scenario analysis. You will have to see how that disruption can affect your business, and you have to look into the future. These are long term. Here again, a discussion and an awareness across the organization is very, very important, and that's really what makes the risk manager's role very critical. And the last point that I want to make here in a good risk framework, and that is the hardest to implement, there has to be somewhere quantification of opportunity loss. The whole decision making today is geared to being safe, and therefore, as long as you keep saying no, you are not making a mistake. But where is the tracking of what you said no to but was a great risk to have taken? And I think if you can strike a balance on that, then a risk manager would be doing justice to his role and to the organization.
I can see Mr. Sood agreeing with you. Opportunity lost and quantification of that. But you know, we talked, Mr. Gupta has really brought in the banks, the financial institutions perspective. Let's talk about that framework, the ideal framework. What would you add to it based on your sector?
Right now, what we are grappling with is basically 3 types of risks, which we call the known risk. We know that it is going to happen, and we have some mechanism to basically fix them. Then we have some risk, what we call the known unknown. We know those risks and all these, which can come to us. We are not very sure when they will come, but we have fair idea that they can always come and hit us any point of time. But right now, what is happening, what is basically most killing us at this point of time is the unknown. We don't know from where this risk will drop in, like change in regulations. So with this framework and all those things, I mean, we have been able to manage the known risk and known unknown, but frankly speaking, we have no means to basically counter this unknown risk, and I think no way you can control it.
Okay, well, first of all, thank you for an honest admission that, you know, there are those unknowns which are really beyond grasp. But Mr. Javasha, again, sectoral expertise, bring it to bear and say, this is how you would go about, you know, building a framework today.
When you are in diverse business, the unknown becomes more a factor to be considered. But the question is that as long as the top management realizes and involves you right from the beginning, many of these things can be mitigated. Like for example, you know, if one keeps his ego aside and involves the risk manager right from day one, when you are doing a merger and acquisition, when you are buying an asset worth billions of dollars, and when you are doing your due diligence, you should be having your risk manager also forming part of that team. And in our case, it does happen that he is made a part of the team. Maybe as Mr. Sood said, you know, one learns a sadder but a wiser man out of experience. But having said that, I mean, we have faced a lot of challenges, you know, when we have done acquisitions, especially outside in countries like the US, where we talk of environmental losses, where we talk of media tech liability. And so to be, in inverted commas, the role is, in one sentence, protection of the balance sheet and contribution to the bottom line.
And therefore, there is, you know, it is essential that the risk management unit, the risk managers be completely integrated into the business decision-making processes of the company. Mr. Ojha.
Can I just paraphrase a little bit? So, panelists have put it very eloquently, but what I would like to say is, the real risks are not the ones where we think there is a risk, but the ones which we think we know really well. So that there lies the biggest danger. Now, as he said, unknowns can be tackled through only one way, I mean, praying to God and whatever. But I think there are a couple of other mitigating mechanisms. One, he said it in a different context, ego, but we are in a capital markets industry, and what we realize is ego in terms of thinking that you know a lot. Healthy skepticism of what you are doing, trying to understand that, you know, whatever risk, whatever money you are making, trying to understand what is the source of your P&L, what is the thing which gives you bread and butter. If you understand it properly, and if you are very skeptic about, you know, how will tomorrow shape up, then probably you are in a better position to face it when it comes.
Okay, so, you know, your message is healthy skepticism is an essential part of a risk management framework. You know, in the course of the conversations that we've had around risk management, I hear this, both thoughts voiced. One is that, you know, you need to develop business acumen in your risk managers. The other is that every business manager now has to factor in risk and think like a risk manager. That sounds great. How do you operationalize it? What do you do in an organization to really achieve both those goals?
I think having a good policy framework and communicating, you know, the policies is the first step to embed, you know, these things right down to the organization. Many organizations, they put up, you know, policy framework, and that policy framework is restricted to, you know, just board of directors and maybe few senior management, you know, level guys, and that's it. Down, you know, the level, people, you know, don't know that yes, these are the risks which are there for the overall business, or maybe even for that particular department, and this is the corporate policy to manage these risks. And if these things are going down, you can have a higher participation and also awareness at, you know, lower levels or maybe mid levels, where they understand what is the risk, and when they are doing business, they'll be able to even appreciate and take certain decisions considering, you know, those risk aspects.
I'm going to encourage all of you to share some examples here, because like I said, it sounds very appealing, perhaps even achievable to say that, you know, we built a risk culture within our companies. But really, Mr. Sood, you know, I'm going to encourage you to really share with us some real live example.
Again, you know, I think, I mean, instead of, you know, I mean, basically staying with the businesses, I would like to move to a very interesting topic, which is called cricket. And I think I would like to give a example with that. I mean, one of the best batsmen for the one-day matches is Sachin Tendulkar, basically opens the batting and all those things. How he evolved as an open batsman, the guy was playing at number 3, doing very well, world record beater and all those things. One fine morning, somebody took a risk and put him at the top. I'm very sure on that day, if you would have asked any of the risk managers sitting here, who should open the batting, I'm very sure nobody would have told Sachin should open the batting because the guy was doing well. Risk manager, basically, risk management always pushes you to the conservatism. The age-old, experienced practices, basically, they try to push you on that. Stay with those tested practices. They will never allow innovation.
Safe rather than sound.
Safe rather than sound. And I think there I always request all risk managers, please, at the time of the, you know, it's always better when we are speeding very fast, you give a signal that you are going too fast. But obviously, please also tell us when we are going too slow and all those things that we need to push the accelerator and move much faster. And I think it has to be a balanced approach. And this is the way it should happen.
Mr. Jivasha, I'm wondering if I can draw you in with a response which could be a contrary one here.
Yeah, thank you for doing that. Maybe you saw my expression. First and foremost, I am a risk taker. And I like to do out-of-the-box things and done a lot of introductions in the market, new things. One is the first loss cover. See, people, it's very difficult to make the management understand that it's always not necessary to be on full cover, as we call it, you know, insure fully, and thereby save a lot of precious cash. So that's one example which I give where it was one thing, nobody likes change. And when you want to be the change maker in your organization, you could be one of the most hated guys, but that's part of the deal. See, but one thing in this I must say, even the industry does not support. And we as risk managers need to convince the management to take calculated risks. We cannot be just taking any sort of risk, but calculated risks are a must.
Okay, time for closing comments from each one of you. And very quickly, got a different question for each one of you. But Mr. Gupta, to you first. The perceived importance of risk management within companies. Do you think in India Inc. it has risen?
Oh, I'm sure it has risen. It has risen for the simple reason that we have seen people coming to grief because they were either too exuberant or they did not see the environment in its totality, and it was too late by the time they responded. So, I mean, there is no doubt about it that it's risen, and it's a very integral part of any business. It's going to be very important. I would only say that, it's not really always adversarial, but if it starts from the top, then it can get embedded. Now, you'll have to address different segments differently. So, you start with a mission and a value statement, and at the operational level, you have to just keep drilling it down and show zero tolerance to certain things, which is moral turpitude and things like that. That is one part. Now, on the other part, it is a lot harder because then you need to involve people in a discussion. So, you must have open discussions. You must get people to try and quantify different risks, and you must get them to solve, give alternatives and even set strategy. You may eventually do what you wish at the very top, but the very fact that you have that kind of a discussion going sensitizes people. And for the uncontrollable risks you have, because there is no moral hazard in an uncontrollable risk, you have mitigants like insurance, you have mitigants like derivatives, if oil prices rise, you can be hedging yourself against it. And eventually, there again, a certain amount of strategic thinking into the future
is important.
You have to take a call.
Looking into the future is increasingly becoming a part of the risk manager's job profile. Mr. Balachandran, traditionally, risk managers have focused on regulatory issues. they've focused on regulatory risk, they've focused on legal risk. I mean, you know, that's traditionally been the norm. You know, in your experience, has that role now pushed beyond to really cover business strategy as well, to look into the future, as everyone on this panel is alluding, is necessary for a risk manager to do?
Absolutely. I think, again, if you were to look at the evolution and the environment which has caused this change, I think we have come across a series of, if you can really call them as failures, on account of, let's say, a lack of risk management in place. I think that's what has significantly necessitated people to, and even for regulators for the matter of fact, to start putting in appropriate directions and regulations to say that every company needs to have in place an appropriate risk management appropriate to their businesses. I think that's what the whole evolution in terms of the reasons why companies have started to adopt risk management more in terms of regulatory and more in terms of the legal compliances thereof. But is that good enough? So again, if you were to look at, let's say, the kind of industry which we are into, I think we are handling policyholders' money. I think the biggest thing is it enough for us to, let's say, just, because at the end of the day, we need to make sure that a genuine claimant gets his money back. And hence, is it just enough for us to put in place just a framework and more from a compliance requirement? Definitely not. Because the kind of risks that we are exposed to extends beyond legal and compliance. Again, if I were to take again examples of our own industry, we again do a lot of risk transfer to reinsurers. So to that extent, we are significantly exposed to any possibility of a default from any of the reinsurers. We need to make sure that we are appropriately addressing that. And as I said, we are again handling policyholders' money, which would essentially mean the risks which are again resulting from investments. So to my mind, I think it's not enough for organizations to just stay focused on just meeting the requirements of regulation. It's all about building the right risk culture within the organization. And it's not enough just for people to talk at the top. We just need to make sure that that kind of a communication starts right from the time, let's say, a person joins a company. Are you making sure that the person is significantly given an exposure to, in the form of an appropriate induction? That's one. Secondly, how effectively is an organization from time to time communicating what are the various risks which an organization is exposed to? Third, how serious is an organization in terms of their risk implementations? Again, if one wants to draw a parallel from an insurance industry standpoint, I think typically the insurance people understand a combined ratio, which is effectively how much money are you making out of insurance operations. If the company is serious about the kind of, if they want to run the business effectively, I think again the communication has to go right from the time a person joins, and you have to create a platform. It's not enough for you to just put in place a framework. You need to make sure that you create the right platform by which it is appropriately shared, and there's a right level of dissemination which happens to people. One. And the last of the points, I would say that it's not enough for you to just know what are the existing risks which an organization is exposed to. You also have to look at events of stress. That's the real test. At what point of time would the business start to collapse, given that you're working with multi-product, multi-channel, and a multi-geography? I think that, to my mind, would be the core for the risk management things in place.
Mr. Ojha, I hear the terms data analytics thrown up whenever I pose questions on risk management, and I ask you this. Fine, data, fine, analytics. How do you go beyond to really translate into insights which then become meaningful from a business point of view?
Before I do that, I just had one small thing to add to the whole discussion here. Everybody has talked about how the junior most employees should be sensitized about risk. One missing link here is that how do you align the incentive structure so that everybody is already sensitive about risk. So example, I'll give you a very pertinent example here. We are a trading firm. We do a lot of other things, but trading is one part of our operations where I manage capital market risks. Now, traders are paid as per the money which they make in the markets. So they are very keen on taking as much risk as possible. And the risk guy is very keen on stopping any undue risks. Now, I think in situations like this, it's the buck stops at the top, and the CEO or the promoter is the one who decides that when I like taking the risk and when I think that, you know, as I saw a movie, there's, you know, I listen to terms sometime that when shit hits the roof. So he should know that when to stop. That's one very important. And regarding data analytics, I think mathematics is one aspect of it, and I'm sure it's very pertinent to insurance industry. But I think the most important thing is having commonsensical approach. I'll give you a very pertinent example. NECL, for example, the NECL scam which happened, a lot of investors lost their money there. The product was very simple and all, but nobody ever checked that whether warehouses are there, are the receipts which we are seeing, are they really backed by physical commodity and so on. And such simple questions would have saved so many investors the trouble. So what I am saying is maths is fine, but as far as the commonsensical approach is concerned, you should always be inquisitive about what are the fundamental drivers of your business, and always be ready to question them.
Well, in summary, companies are placing greater and greater importance on risk management. And from what we've heard from this panel, risk management itself is becoming enterprise-wide and is becoming much more forward-looking. So if I can use my layman's summary, can I say safely that it's never been a more exciting time to be a risk manager, and it's never been a more challenging time to be a risk manager? Thank you all very much for joining us on this discussion. Great talking to you.